of various financial instruments, indices, Nasdaq stocks, and cryptocurrencies. There are various divergences and correlations among various financial instruments, various indices, various sectors, and various individual assets. For example, cryptocurrencies are correlated to the Nasdaq, and here we can see that the rational markets hypothesis is quite wrong. Cryptocurrencies originate as tools that serve to abate inflationary pressures. The way the algorithms of most of them are designed, they should be inversely correlated with inflation. They should be seen by the market as a safe haven asset from rising prices, much more so than gold. But does the average investor know what they are buying? Or is he investing because others are investing? Because if he knew what he was buying, he would buy more during an inflationary flurry. Instead, he implements risk-off behavior linked to the money supply and the monetary policies of central banks. Average investors still conceive of them as risky assets and invest in them if they have more money available and disinvest if they have less. As they behave with the Nasdaq, they behave with cryptocurrencies. It's just a matter of risk on or risk off. This, in addition to showing that markets are not rational at all but only have a fashionable logic that becomes even less predictable, shows us that identifying correlations is crucial to making money. But what are the most important correlations to watch for in the markets? Of course, it depends on your investment style, your risk appetite, and your time objectives. But in general, as we have said many times before, the first thing you should always watch is the Federal Reserve, which gives the signal to all markets of how much you can risk. As we will see later in the video regarding fundamental analysis applied to indices, monetary policy only shifts the time objective of the markets. You will understand this better in a moment when we look at the logic behind the use of the yield curve. Still, right now, we can say that tight monetary policy increases the market's perceived risk and lowers the time objectives of investments, effectively lowering the valuations of individual companies and the indices of which they are a part. Simply put, if the future is clear and there is a central bank printing money for me, I can invest with a longer time horizon. If the opposite happens, I cannot. But if you lower the time horizon, the valuation of the individual company, which is nothing more than the discounting of its future profits or future cash flows, will be lowered because I will increase the discount rate and decrease the years taken into consideration. Do you see how the time variable is critical to understanding markets? If you had trouble understanding what I just said, especially concerning the method of valuing a company or the concept of discounted earnings, don't worry, because there will be a dedicated video later on that will go into more detail on these hints of financial mathematics and business valuation. Coming back to us, the Federal Reserve and the positive correlation between its monetary policy and the markets are the first thing to consider. Then the second correlation is the correlation between the S&P 500 and the Nasdaq. If you want to maintain an investment in the US stock markets, it is preferable to hold investments in the former index when monetary policy is tightening, while in the case of expansionary monetary policy, better the latter. In general, the Nasdaq 100 has 1.3 to 1.5 times the volatility of the S&P 500. This means that at a plus 10% performance of the S&P 500, we usually have a plus 14% performance of the Nasdaq 100 and vice versa. If negative 10%, we have a minus 14% of the technology index by definition. More generally, the correlation between world stock markets and the two US indices is very high, especially in the medium term, especially since it makes no sense to invest in other stock exchanges if you do not consider currency risk if you are a resident of states that do not use the US dollar or currencies pegged to it, from which you can hedge anyway. In terms of world foreign exchange reserves, just think that 61% of the reserves are in US dollars and 20% in euros, and there are yen at 7% and British pound at 4%. Those in Chinese yen amount to 3% of the total. This shows that in any case, at least 60% of the portfolio invested in the stock market should be put in US exchanges if one wants to have neutrality concerning world currency movements. Now, we could list many other correlations for you, such as between commodities and stock markets, such as between gold and the S&P 500 and an infinity of others. Still, instead, we will point you to just one more that is perhaps the most important, because there are communicating vessels that between the bond market and the stock market, a global fund manager, when he has to decide to invest a higher percentage in the bond market and a lower percentage in the stock market, liquidates billions of dollars of equities and buys billions of dollars of bonds, or he does the reverse when, on the contrary, he decides to increase the exposure on equities and reduce the exposure on bonds. When investing, one of the questions to ask is whether the economic scenario will direct money to the bond market or is more conducive to directing it to the stock market. These are markets competing to receive your money. There are phases, such as the one we are experiencing in the first half of 2022, that are not favourable to either market because rates are expected to rise. These are phases that are exceptions to the rule, but must be considered. Forget about all the other correlations. Simplify your reasoning. Even if you are an asset manager, the most profitable path is that of simplicity. The effort is to try to simplify complexity, not add to it. It is interference that brings success, not inductivity. Diving into the market with complicated analysis and predictive algorithms with mathematics unattainable by ordinary mortals certainly makes the financial world more fascinating. You know the one about the inductivist turkey? The turkey loves his master because he fattens him up by making him eat a lot for 364 days. The turkey then, not looking at it from above through a theory but based on a daily experience, makes two mistakes. The first is that it believes its master loves it, and the second is that it believes that on Thanksgiving Day it will stay alive and eat a lot. Poor thing doesn't know it will be eaten. So better to look at things from the top rather than as mice locked in a maze. And to look from the top, you have to move from a theory or model, and especially make sure that the model is as simple as possible. Finding synthesis variables using other studies. For example, why do we tell you to look at the Federal Reserve? Because behind the Fed's choices are very complicated econometric models, political and geopolitical choices. They are a sum of many other variables. Still, we only need to look at one to monitor hundreds. Simplifying complexity is the watchword. So, we will not give you any more correlations or variables to monitor. Those mentioned are enough to develop winning methodologies in the markets. The rest is confusion.